Welcome to the 2022 Snapshot on Markets and Economic Review. Hi, I'm Cameron Forbes, Senior Advisor at Forbes Fava Financial Planning. As always, please see the general advice warning. We're not taking into account anybody's personal objectives or financial situations today. If you do require advice personally, please contact a suitable authorized financial advisor. A lot's happened in 2022 financial year. We've had a federal election, new Prime Minister Anthony Albanese. We've had the Ukraine being invaded by Russia. We continually hear now about inflation. We've had some winding back of emergency policy measures after the pandemic. We've all experienced supply chain issues. There's been significant floods in New South Wales and Queensland. We've had increasing interest rates by the Reserve Bank of Australia to try to monitor and keep inflation in check. House prices did rise throughout the COVID pandemic, but we have seen in May and June 2022, 2 consecutive months where the prices did decline on property. The government is also committed to cut emissions with an objective of net zero by 2050. Unemployment, for the first time in a very, very long time, is forecast to go below 4%. A lot of businesses and employers have been dealing with staffing shortages after the pandemic and with limited immigration. And we've all probably now started to experience some of the travel issues and also dealing with some of the vaccination mandates. So a lot has happened over the last year. But what are the important takeouts? Well, there has been a lot of volatility in the markets, and this is what this does illustrate here. It's not unusual to have this amount of volatility. And what this is illustrating here is the best and worst trading days often occur very close together and irrespective of the overall market performance for that year. The data for the last 3 decades has a clear message for investors. Even a bad year for markets can deliver some of the best single-day returns for an investor. Some of these will be the best they may experience in their lifetime. For this very reason, investors should continue to invest to build up their long-term wealth, such as for retirement. Investors with the long-term goals and to continue to maintain the principles for investing for success. We're strongly in favour of setting your long-term goals, following a balanced and diversified strategy, and maintaining the discipline. As we can see on this chart here, the red is showing us the worst days and the green is showing us the best days, but we can see a close correlation between them both over the last 3 decades. I have reviewed a lot of the superannuation returns over the last 12 months financial year just to see who's done what, and I guess I'm expecting that most people this year in a balanced type investment would probably expect a negative return on their statement when they get their superannuation end of year statement and or investment statement. It is very much normal for the last 12 months. There was no real escaping it. Also, just to cover off and go over some of the main indices and what happened over the last 12 months, we can see here over the last 1 year here, for example, the S&P ASX 300 was in a negative return. Industrials, resources did have a small positive return. We had real estate here in negative, and also the small ords accumulation index as well. We've also got the MSCI, so this is in regards to the global space as well, which was all in negative territory. Now, you're probably asking, where was some of the positive returns? Well, I'm sure you've seen it in the petrol pump recently with petrol prices. There was a positive return there for crude oil. If you do require any personal advice, please feel free to give us a call. We do remain optimistic about the future, and we'll continue to review and monitor the economic and market information to make it simple for our clients and what it means for them. We hope you have a great day. And once again, if you do have any questions or queries, please feel free to give us a call. I will just leave on one last note, and it's something that is continually discussed or has been continually discussed with our clients for many years. A typical analogy that I may use if an investor or a client has contacted me or is speaking with me, just in regards to their investment strategy and if there is some volatility in the market. Often they ask questions like, well, should we move back to cash and sit out and wait? Well, as you've seen in the previous slides, we've explained there over the last 30 years the correlation between the worst and the best. But one of the simple analogies that I usually use with my clients is, if you owned an investment property and on the news they told you the value of the area where your property is located has just had its capital value drop by 30%. My question to the clients is then, would you kick out your tenants? Usually clients then screw up their face, shake their head, and reply with something along the lines of, that would be crazy, Cameron. Why would I kick out my tenants? They're paying rent, which is income. I would never want to move my tenants out. I would even delay increasing their rent to keep them in there to know I have the security of the rental income. I'm not looking to sell this property for a long time. The value of it today does not concern me. It's a long-term investment. I usually reply with something along the lines of, well, if you see your retirement savings drop in paper value, don't panic. Almost half of your returns are income, interest, and dividends. So don't kick out your tenants. This is a long-term investment. You don't need that capital today. This is just an analogy I use with my clients to explain and rationalize some of their thoughts, feelings, and emotions, which of course are very valid. I'll leave you with that today. Once again, if you'd like to reach out and contact us, please feel free. Bye for now.